Almost every human being has the ability to get rich. But some money habits keep them stuck in poverty. Almost 90% people are poor, not because they can't earn more money, but only because they have bad money habits. Well, in this video, I will be telling you few most common mistakes which are keeping you broke and poor. 1. Delaying investment till you have more money. The magic of compound interest puts time on your end when it comes to investing. Contrary to common assumption, you don't even have to have a big salary to start off if you're not an expert in personal finance. One of the easiest ways to invest is to sign up for your company's 401k, a Roth IRA, or a regular IRA, tax-advantaged retirement savings accounts that enable you to accumulate money over time. Acorns, an app that allows you to invest your spare change, is one example of an app that aims to make investing easy and accessible. You may also research automated investment services known as robo-advisors. So the most important thing is to move quickly. Establish the practice of saving at least a small amount each month, even if you are unable to invest much. Reevaluate how much money you can realistically set away whenever you receive a pay raise or bonus. 2. Failing to take insurance. It's simple to dismiss insurance while you're young in order to save a little money each year and assume you're indestructible. But simply one mishap might obliterate all of your money. Most insurance plans are private. Study your policy carefully before agreeing to it, obtain many quotes, shop about, study them all carefully, and ask questions if you don't understand anything to ensure that you have the greatest coverage possible for your particular scenario. Before deciding on an insurance plan for yourself, read as much as you can. If you are finding this video informative, then do like the video and also consider subscribing our channel. 3. Using up your entire salary. When you live paycheck to paycheck, you run the risk of accruing credit card debt since your spending is equal to or higher than your income. With such way of living, saving much money is almost impossible. 4. Not having a financial objective. If you want to save more money, you must first have a precise goal in mind before creating a strategy to get it. Money doesn't just magically materialize. Determine exactly what significant purchases, such as a home, automobile, or your children's education, you intend to make in the future. Then, decide how much and how long you need to save for them. Last but not least, to make sure you stick to your savings goal, set up a recurrent automated transfer from your checking account to your savings account. 5. Executing late payments. Missing payments not only cost you money and fines, but they may also negatively impact your credit score, which can limit your capacity to borrow money in the near future for larger purchases like a home or vehicle. By setting up online automatic payments for recurring expenses like cable, internet, and insurance, you'll never again forget to pay a bill. Put out calendar reminders and pay non-online bills at the same time each month to establish a habit for things like rent that cannot be paid online. 6. Paying only the minimal amount due on your credit card bill. Most credit cards merely ask for monthly payments of 1% to 3% of your amount. Paying the bare minimum might be a seductive alternative, especially if your finances are tight, but it will end up costing you a lot of money in the long term since interest will be charged on the sum that is still owed. Establish the practice of paying every bill in full. Are you finding the simplest method to do that? Set up a monthly transfer from your bank account to your credit card issuer of the entire amount you owe. Consider going on a cash diet and cutting out your use of plastic for a period if you frequently overcharge and find it difficult to pay more than the minimum. 7. Not knowing at which your money is being spent. It's much too simple to waste money on thoughtless purchases, whether it's calling an Uber, making a regular trip to the neighborhood bodega, or purchasing a Coke while standing in line to pay. Try keeping track of your spending to have a better understanding of where you spend your money and at which you may make savings. Do not end there. Spend that excess money on anything like placing it in a retirement account or another type of savings account so it can increase over time. 8. Dipping into savings. Once you've established a retirement savings account, don't touch it. Your financial future is at danger because you're delaying your retirement funds from increasing over time. In addition to paying fees, most conventional IRA withdrawals made before age 59.5 are subject to taxes and a penalty. The same guideline is applicable to your emergency fund. Don't access it until you're in the midst of a catastrophe that endangers your life. Move the money into a different account, such as a money market account or a high-interest savings account, which both provide greater interest rates than a standard savings account, to erect a mental and physical barrier between you and the money. 9. Trying to embarrass your pals. Living up to your friends' or coworkers' expectations might be tempting, and if you do it, you're not the only one. According to an American Institute of CPAs poll, 78% of people aged 25 to 34 base their financial decisions on those of their peers. Nevertheless, basing your decisions on where your friends go out to eat, what to dress, and what technology to buy might ruin your finances. You shouldn't assume you can afford something because your buddy appears to be able to, such as the newest Apple device or an all-inclusive vacation to the Caribbean. 10. Ignoring something. Despite your desire to disregard financial warning signs, you are better off taking care of any problems straight away. No matter how low you suspect the amount may be, check your bank account and credit score. Leave paying off your debt today, not tomorrow. And make use of the advantages and privileges offered by your employer, which might result in annual savings of thousands of dollars. Ignoring your debts and bills will result in its accumulation, which will ultimately cost high amount of money reduction at a single time. 11. Making low-interest debt a secondary concern. There are several types of debt. Ranking your debts in order of interest rate, from highest to lowest, is a successful method of repaying debt. Next, pay the minimal amount due on each loan while giving priority to the debt with the greatest interest rate in order to pay less overall, over time. An alternative strategy is to rank your debts according to magnitude, beginning with the lowest. Expert on personal finance Dave Ramsey refers to it as the snowball method. It is intended that when you eliminate one type of debt, momentum will grow, enabling you to take on the other largest obligation, and so on. That's all for the video. If you learned something new, then do subscribe our channel and also press the like button. Thanks for watching.